Hi, good morning. This is November the 1st, and we're heading into the Christmas season. But I just thought to give you a bit of feedback on where we are, what's happening on the markets. The last time I gave you feedback was basically about the war in the Ukraine, the effect of that. I showed you how markets react. And yes, we were down, but we were not in the trouble that most people thought we were. But I must admit, we are actually at this point in time going through some stormy waters concerning the markets. It's up one day, down the other day, and many of us feel overwhelmed or can feel overwhelmed. So, this short little video just shows us what we are going through, and I hope you can get the gist of this. And I think when we go through these type of storms in the financial markets, we really want to bail out. We think moving to the money market is the best. It will protect us, but we shouldn't do that because at the end of the day, we will enter calmer waters again. So it's very important that we look at the situation that it's hand. I also want to give us some feedback concerning the markets. Portfoliometrix gives us great feedback. When we look at this performance, it's a smorgasbord of different asset classes from SA bonds, the rand, dollar, property, cash, South African equities, global properties, and how they performed over different time periods. And here in 2020, we can see global equities performed excellently, as in 29. Global bonds did extremely well. In 2021, we see that global property was the best performing asset class. South African property did very well as well. Global equity still did well, and then South African equity. So all of the main asset classes did quite well. Global bonds started falling out of favor. But if we look in the year to date 2022, we can see that there were no asset classes. The best performing asset class was cash. South African cash 3.6%. Even global bonds are down 9.8%, and South African equity down 10%, even global equity down 15%. So there were no places to hide, as you can see here. Year to date, all the asset classes, whether it's bonds, US stocks, they all down significantly. Only commodities gave us a glimmer of hope, but we know if we look at this next chart, how volatile commodities have been. This is from 2001. We can see here the volatility, and since 2019, commodities did actually very well. We can call it a safe haven, but we know it's very volatile. So we had an extraordinary year because we can see that global equities and global bonds really underperformed, and that's in US dollar terms. The rand made that we had some better returns on this. Now, this is where we can see that there were no places to hide. If we look at a portfolio that's made up of 60% stocks and 40% bonds, traditionally this would be a portfolio that really gives you a lot of protection. And we can see only 2 years were worse than 22, and that's 1931 and 1974. And here we are again. So we are really in exceptional waters this time, and there's not much we can do about that if both those diversifying factors are both very negative. So here we can see, if we look at an asset allocation portfolio, which is made up of 60% shares and 40% bonds, we can just see the performance over time. In 2021, they still did quite well, but we saw a year to date, we're down minus 19 on that asset allocation portfolio. So if we now look at the currency impact, because we saw the rand depreciating quite a lot against especially the dollar, and here we can see that we were down in currency terms, US dollar terms, minus 26%, but in rand terms, that softened the blow for us a little bit. So this is very interesting when we look at the intra-year, and this is the equity market drawdowns. The red buttons down here just shows us during the year what was the lowest point that the share market performed. And we can see that in many years, even though it ended up positively, there were times, if we look here, 86, 87, I remember that's basically the time that I entered the market. During the year, it was down 34%, but it ended up 2%. Now, we see here in 2008, the year of the global financial crisis, we see that the market was down 49% and it pulled back only a little bit during that year. So this year we can see that the market is still down 25%. So where we're going to end the year, it's anybody's guess, even though it looks like there's a little bit of a turnaround. It can just be for a short period of time. Now, this is an interesting one. This is the global bonds, which gives us the diversifying factor. It should operate counter to the share market, the equity market. And again, during the year, we can see some negative returns, but the year ending mostly positive. And here you can see this is starting at 76, and we're still down 15% on global bonds. So I think the important thing for us to watch is basically what the Fed is busy doing. We know that they are increasing rates quite a lot. When we look at interest rates, and we know that the Fed is hiking that, the blue line is actually the debt servicing cost in the US. So we can see the debt servicing cost has risen much faster than the 10-year Treasury yield have risen. And this cannot continue for quite a long time, so they should taper that off. And this is what the fund managers are also looking at quite intently to see what will happen there. And we can also see here that US interest rates are basically at not an all-time high, but it's higher than it's been for quite a long time. Now, South African inflation, even though our inflation went up to about 7.5%, we still very benign in this space, and we're in a better place than even the US at this point in time. Now, what is holding back our inflation? And that's the low growth that we have in our country. And this is the reason why we don't have runaway inflation like they have in the US at the meantime. Now, markets normally overestimate to where the Fed will take the rate hikes. And at a point in time, we will see that the repo rate will at a point turn around. But at this point in time, there's no telling when the Fed will stop with the rate hikes that we've just seen. So to end off this feedback today, I just want to give you about 3 slides of what Coronation, the feedback that they gave us about a month ago, which just shows us how we should behave and sometimes why we don't behave the correct way. So if we just look at crisis is also an opportunity, and we ask the question, why is it so hard for us to take advantage of a crisis? Now, our human brains are hardwired to survive, and when markets are down, we just want to run for the hills. We don't thinking about the long term. We don't take advantage of crisis. So the hard truth, and this really hit home, the more prices fall, the more afraid we get. And that's so true. And the less we want to be in the market, we want to be out of the market. Now, our brain responds to stories and anecdotes plus emotion, not low prices. You can tell anybody there's a low price going on and they wouldn't want any of that. So if we look at the situation in basically in 2008, the global financial crisis, if we ask again, why don't we just buy when markets turn? Now, there's always bad news flowing when things are going down. So we saw that the market collapsed in 9 months. Markets didn't stabilize at lows for even one trading day. Many times we think that the markets are going to be low for a while and we'll have time to think about it. But for no good reason, look, the markets recovered. On the 9th of March 2009, we hit the bottom. That day it was down -1. But on the 10th, the next day, the market increased by 6%, and the 11th, another percent, and up. 3 months later, it was up 39%. But while it was turning, there was still bad news coming in. People were thinking, no, this can't be. The market will have to fall again. And the same happened when we looked at March 22 with the COVID crisis. Again, the same story. There was a lot of bad news flowing. The 23rd of March was the bottom. There wasn't one day that it stayed that low. The 23rd of March, that day, it declined by 3%. And the next day, the 24th of March, it was up 9%, 25th of percent, and again, 4 months later, it was up 46%. So when we look at what markets are doing, we will never be in a position to accurately time the markets. So as a last word from me, it's best to stay invested if your portfolio is correctly structured. And I believe with the help of Portfoliometrix, we are suitably structured for the longer term. So thank you for listening to this feedback. I hope this will calm your nerves a bit. And who knows, we might be at the bottom or the turning point. It was nice for me, and I would like to also just wish you a wonderful and a blessed Christmas. And let's see what's going to happen in the new year in 2023. All the best from my side.